In this lesson, we want to look at International Financial Reporting Standard 16, IFRS 16, and IFRS 16 talks about leases, a lease contract, and a lease transaction. It gives the provision, or it outlines the principles and concepts that an entity must adapt and apply when the entity faces a lease contract or a lease transaction. So in this lesson, our focus is going to be on IFRS 16, International Financial Reporting 16. Leases. So just as we've been doing for other standards, we go through the hierarchical process to establish our understanding in leases. So we'll focus on the objective, the scope, how to recognize, how to measure leases, and how to de-recognize leases from the books of the entity, as well as how to present and disclose the relevant information in the books of the financial statement. That is the basic thing we are going to look at. When we talk about leases, we are going to look at three main things. Our discussion is going to be based on three main things. We will look at the lessee accounting. So we are going to look at the lessee accounting, the lessor accounting, and then we are going to look at what we call sale and leaseback. Sale and leaseback. So these three, so this is lessee accounting, and then the lessor accounting. So our focus in leases is going to be on how to account for a lease contract when from the perspective of a lessee. In a moment, you'll get to know who is a lessee and who is a lessor and what goes into a sale and then a leaseback. Please, if you've not subscribed to RONAS Academy, kindly subscribe and share with others so that we can widen our learning community. Thank you. Alright, so before we go to the main thing, lessee accounting, we need to know some basic things in the lease contract. Some basic things, the objective, the scope, the definition of some key terms before we can start looking at the key topics in the leases. Now, the first thing we want to look at is the objective. What is the objective of leases? The objective, according to IFRS 16, the standard provides the principle for an entity to adapt in recognizing, in measuring, in presenting and disclosing a lease contract. That is the principle. So you see, lease contract is something that is a bit complicated. Don't forget, we previously had a standard which has to do with IAS 17. Previously, leases was accounted for under IAS 17. IAS 17. And when it comes to IAS 17, there were some anomalies, there were some deficiencies in the standard that led to the revision. And the revision, led to a substantive revision of some key terms, substantive revision of the subject matter. Therefore, they cannot revise IAS 17. They have to revise it and give it a new name because the revision led to changes in the substantive subject matter. The subject matter was substantively revised. Therefore, there is a need for the new standard IFRS 16. Now, what were the anomalies in IAS 17, the previous standard IAS 17? The anomalies were that the lessee account for a lease contract either choosing a lease, finance lease, or an operating lease. When it is a finance lease, there are some certain characteristics the lease contract must have or must possess. So for us to say that the lease is a finance lease, it must contain some characteristics. You will get to look at when you are looking at the lessor accounting. And then we also have operating lease. Any lease that is not a finance lease, then it's an operating lease. Now, the treatment is this. Anytime it is an operating lease, then that lease will not be accounted for in the statement of financial position. It doesn't go to the balance sheet if it is an operating lease. That is under the previous standard. It doesn't go there. So most of the entities, even though the lease contract is supposed to be a finance lease, they will account for it as an operating lease, because that's, if they classify it as an operating lease, it will not show on the face of the financial statement. So entities were doing this kind of anomaly. They were hiding behind the scene and creating their own accounting, creating their own finance list, how to classify them, and they were not following the standard judiciously. According to a report from the US, uh, Securities Exchange Commission, trillion, not even billion, 1.3 trillion lease contracts was in operation. But if you go to the books of the entities, none of those lease contract was found in the statement of financial position. That means they treated such lease as what? As an operating lease. So such a great anomaly was not giving the true and fair, financial statement of the entity, and therefore there was a need to revise this particular standard. So the standard prescribed, the standard IFRS 16, the new one, prescribed the principles governing recognition, the principles governing measurement, the principle governing the presentation and disclosure of lease contract. Now, the main objective of IFRS 16 is to aid the lessor and then the lessee to provide an information that faithfully, or to provide an information in a manner that faithfully represents those transactions. The objective is as simple as this: is to aid a lessee and then a lessor to provide us with an information, okay? To provide us with an information in a manner that faithfully represents the lease contract. So, if you are accounting for lease in the books of the entity as a lessee or as a lessor, the information you provide should faithfully represent the core subject of the lease contract or the lease transaction. So you cannot just account for the lease contract as a finance lease, as operating lease, when in actual fact it is none of the above. So that is the basic objective of IFRS 16 leases. Moving from the objective, we want to look at the scope. What are some of the things the standards cover, and what are some of the things the standard do not cover? Here in scope, we are looking at the delimitations of the standard, the things the standard cover, and then the items the standard do not cover. When you talk about lease, IFRS 16 covers all lease contracts. It covers all lease contracts. All lease contracts, including sub-lease contracts. Including sub-lease. So the standard covers all lease contracts, and sub-lease contracts. When we talk about sub-lease, it is when, let's say, this is A and B. This is the lessor, okay, and this is the lessee. That means this one has leased an asset from A. We will look at the meaning of lessor and the lessee very soon with the terms, the definition of terms. So this lessee, the B, has obtained an asset from A, and this B has also leased the asset to C. Then this particular transaction between B and then C will be regarded as a sublease. A sublease. It is when the right of use asset is leased again to a third party. That is when we say it's a sublease. And IFRS 16 covers all lease contracts, including sublease. Now, the following items IFRS 16 do not cover. IFRS 16 do not cover the following items. The first one has to do with the lease to exploit or use of minerals, oils, and any other items of a similar nature. The lease to exploit or use minerals, oils, and any of item that is of a similar nature. The standard does not cover that. So the lease of an intellectual property, which is accounted for under a different standard, does not fall under IFRS 16. A lease for an intellectual property does not fall here. Service concession arrangement, service concession arrangement also have its own standard that has to do with IFRIC 12. Service concession agreement that has to do with some form of transactions with the government, and it does not also fall within IFRS 16. You can also look at the right held by LC under licensing arrangement, which falls under IAS 38, intangible assets. So that also falls under IAS 38. So it doesn't fall within this particular standard. Now, please take note of this statement I'm about making. Despite we are looking at the IFRS 16 governing all lease contracts, an entity must also consider the terms and the conditions of the contract, and also all facts and circumstances of the contract must be taken into consideration when using this particular or when applying this particular standard. Don't forget, despite we have looked at the scope, an entity must also look at the terms and then the conditions, then also the facts and circumstances in the contract when applying this particular standard. Now let's look at what is a lease, which contract is a lease, and which contract is not a lease. So we want to look at identification of a lease contract. How do we identify a lease contract? It's very important, because if you can have a contract with an entity and that contract might fall within even a contract with a customer which is not within this scope, or which does not fall within the scope of leases. So there is always a need to identify whether the contract is a lease contract or is not a lease contract. So that is what we are looking at, identification of a lease contract. Now the standard says that when we say a contract is a lease, then that contract is a lease or contains a lease. So a contract is a lease or contains a lease. A lease. When that contract conveys the control of an identified asset. So if the contract conveys a control of an identified asset in exchange for a transaction, then we say that particular contract contains a lease. So what I just said is that we say that a contract is a lease or it contains a lease when that contract conveys. So the contract is going to convey the control. So in the contract, let me use party A and party B. So the party A and party B are having a contract, and party B has obtained control of an identified asset. Let's use phone, for instance. You are going to use the phone for 6 months, for 1 year, for 3 years. That is the contract. They are going to use B, who is taking the asset from A, has conveyed that control to B, and B in return is going to give some form of some form of consideration to A in exchange for consideration. When that happens, we are saying that that is a lease contract. That contract contains a lease. Now let's look at an updated version or an upgrade of what the statement I just made, or let's take it as an exception. There are some times where a lease contract may contain a lease and also a non-lease component. So we are looking at, this is a one contract, but part of it is a lease contract, part of it is a lease contract, and part of it is a non-lease contract. You may also have a contract like that. But before we come here, let's look at definition of some key terms. What is a lease? What is a lease? What is a lease? If you identified that a contract is a lease, then definition should not be your problem. What is a lease? When we talk about a lease is a contract or part of a contract that conveys the right to use an underlying asset. So when we talk about a lease contract, we are making reference to the fact that is a contract or a part of a contract that conveys the right. It conveys the right to use an underlying asset for a given period of time in exchange for a consideration. So as I was using the entity A and entity B, A provides the assets to B. B controls the assets or obtains the right to use the assets in exchange by paying A some form of what? A consideration. So this contract takes period of time. When that happens, and we have also assessed that the contract contains a lease, then we are saying that that is a lease. Now, if you want to explain this in a layman's view, we are saying that a lease contract is a contract between party A and party B. This party A and party B is nobody, or they are nobody but a lessor and a lessee. Now, the lessor provides the asset to the lessee, and in return, the lessee exchange that asset in the form of what? A consideration, or pays consideration to the lessor for a given period of time. That is the basic meaning of leases. Now, we need to distinguish between who is a lessee and who is a lessor. Now, the distinction between lessee and lessor is a matter of who provides the underlying assets and who obtains the underlying assets. When we talk about underlying asset, it is the subject matter, the subject item in the lease. So, for instance, if you lease a phone, the phone is the underlying asset. If you are leasing a building, you're leasing a vehicle, you are leasing a land, you are leasing a truck, such items that you are leasing from one party and in exchange for a consideration by the other party, that item in the contract is what we are referring to as a underlying asset. Now, we want to distinguish between who a lessee is and who a lessor is. Like I indicated earlier on, the distinction is just a matter of who is providing the underlying asset and who obtains the underlying asset. Now, the lessee is a party that obtains an underlying asset or the right to use an underlying asset in exchange for a consideration. That is the lessee. So the lessee, in actual sense, obtains the right to use an underlying asset, while the lessor provides the right to use an underlying asset in exchange for a consideration. If you take a critical look at the definition, the definitions are the same. They are all the same. The definitions, they are the same. But the only keyword that is bringing the distinction is one is obtaining and the other is what? Providing. That is the differences between a lessee and a lessor. Now, we also have to look at this term that we will be using often: commencement date and inception date. So we want to look at the difference between inception date and the commencement date. They are generally they are different, but in certain circumstances they can be the same. I will show you in the situations or circumstances where they can be the same and situations where they can be different. Now, when we talk about the inception date, it is the date on which the two parties entered into a contract where they are committed to the terms, the conditions, the facts and circumstances to the contract. That date is the inception date. Please take note. The date of the contract between party A, the lessor, and the lessee, where both are committed or both have outlined the clauses of the contract. That is the terms, the condition, the responsibilities, the facts and circumstances of the contract. On that date, we are saying that that date is the inception date. When we talk about the commencement date is the date on which the lessor provides the underlying assets to the lessee. That date. So we can enter into the contract on 1st of January 2020, but this is not the date the lessor provides the assets to the lessor. The commencement date is the date where the lessor provides the assets to the lessee. So it can be done on, let's say, 31st of March 2020. So you can see this date and this date are not the same in terms of this contract. But there are some times where the inception date and commencement date will be the same, because on the day that they entered into the contract is the same date that the lessor provides the assets to the lessee. When that happens, then we are saying that the commencement date and then the inception date are the same. Please take note. Please take note. The inception date, the commencement date. The date the entities are committed to the contract is the inception date. The date the lessor provides the asset to the lessor and to the lessee to be used in exchange for a transaction. So in exchange for a consideration, that date is the commencement date. Now let's look at lease term. What is a lease term? What is a lease term? So a lease term, don't forget, we are not done with this yet, where a contract contains a lease contract and a non-lease contract. We will come there. It's something we will have to take a practical question to augment the understanding over there. That's why I have left it hanging, so that we look at the definition and then we go back to it. Then when we are done, we go to the C accounting, the SAW accounting, and then sale and lease back. Sale and lease back. Lease term. Lease term. According to IFRS 16, when we talk about the lease term, it is the non-cancelable period. The non-cancelable period, which include both 1 and 2. So, when we talk about the lease term, it is the non-cancelable period, which includes both 1 and 2. We are coming to look at the two things. So, when we talk about the lease term, actual sense, the lease term is basically the period for which the lessor provides the assets to the lessee. So, for instance, we can enter into a contract to lease an asset for 6 years, to lease an asset for 5 years, to lease an asset for 15 years, 20 years, 50 years. That is the lease term. But the standard, will not give it to you in a plain like that. We are saying that it is the non-cancelable period, including both a period covered by an option to extend the lease if the lessee is reasonably certain to exercise that option. A period covered by an option to extend the lease if the lessee is reasonably certain to exercise that option. That is one. Then the second one is a period covered by an option to terminate the lease. If the lessee is reasonably not certain to exercise that option. This definition is very clear here because of what we call lease modification. We can enter into the contract today, and then the period is for 6 months. The period is for 5 years, is for 2 years. Then, in some period to come, we change that period. We change the years. We have a revision of the years. Then, when that happens, there is a need for lease modification. You'll be looking at that after the lessee accounting. So that's why it's like this, a non-cancelable period. So when we talk about the lease term, it is a non-cancelable period, which includes period covered by an option to extend the lease and period covered by an option to terminate the lease if the lessee is reasonably certain or not certain to exercise that option. That is the meaning of the lease term. That is the meaning of the lease term. So having understood the lease term, having understood what is a lease, what contains a lease contract, which contract is a lease and which contract are not a lease, and then also the difference between a lessee and then the lessor, we now want to proceed to how to account for a contract that contains a lease and also having a non-lease component. So, like I was indicating earlier on, that we can have one contract, and this contract will have a lease component, and then we also have a non-lease component. Anytime a contract is having a lease component and a non-lease component, then there are certain things the lessee or the lessor must do. So let's take the perspective of the lessee first. What should the lessee do when the contract contains a lease contract and a non-lease contract? Anytime a contract contains a lease contract and a non-lease contract, the lessee must split the contract using the stand alone stand-alone price of the individual contract. Anytime a contract contains a lease contract, the contract is having a lease component and a non-lease component. The entity, which is the lessee, must split the lease component from the non-lease component using what we call the stand-alone price. When we talk about stand-alone price, it is the price at which an entity will sell to a customer separately, or will sell separately to a customer. That is what we call a stand-alone price. Now, this stand-alone price you will use here should be an observable stand-alone price from the point of the lessor, because the lessor is the one selling. But if the stand-alone price cannot be determined from the perspective of the lessor, then the lessee is allowed to determine the stand-alone price using the observable evidence from an active market of that particular item. So the question here is, how do we split the two? How do we split the two? We are going to use the stand-alone selling price. Assuming that a contract is being leased for 160,000, is being leased for 160,000 for 180,000, and then the lessee is going to pay 60,000 as a lease payment for 3 years. So the lessee is going to pay 60,000 for 3 years. This is the total amount, which is the amount to $180,000, but the lessee will pay 60,000 for each year, and this is payable at the end of the period. Payable at the end of the period. Payable at the end of the period. Now, this contract is having a lease contract and a non-lease contract. Now, the stand-alone selling price of the lease component is 160,000, and then the stand-alone selling price of the non-lease component is 40,000. 40,000. Yes, sometimes stand-alone selling price, if you add it to it, will be more than the transaction price. It happens. That is where we are going to account for discount. So in this question, we can see that we are having the lease component is 160,000. That's the stand-alone selling price, and then the stand-alone selling price of the non-lease component is 40,000. Now, this 60,000 here, which is the lease payment, must be split using what? The stand-alone selling price. So if you want to get the lease component, it's going to be the summation of these two, which is going to be 160 divided by 200 times the 60, which will give us 48,000 times the 60,000, $48,000. So we are splitting the 60,000 between the lease component and then the non-lease component. When we come to the non-lease component, it's going to be the 40,000, 40 divided by 200 times the 60,000. This is going to give us $12,000. So this will be the non-lease component, and this will be the lease component. So this, we will look at how to initially measure a lease from the lessee perspective and from the lessor perspective, and then subsequent measurement. So this is what will be the annual payment for the lease component, and this is what will be the annual payment for the non-lease component, which will be accounted for under the different standard. It will be accounted for under a different standard. Exception to all that we've done so far. There is a practical expedient in the standard that states that an entity, in fact a lessee, can continue to, even though the lease contracts or the contract contains a lease component and a non-lease component, the entity, which is the lessee, can treat the contract as a lease contract, everything as a lease contract, and that's what we refer to as a practical expedient. So there's a practical expedient that a contract may contain a lease contract and a non-lease contract, but because of that practical expedient, the lessee can choose to treat the whole contract as a lease contract. Then let's go to the lessor. With the lessor, anytime the contract contains a lease component and a non-lease component, then the lessor is allowed to apply that split using the provisions of IFRS 15. Contracts, revenue from contract with customers, IFRS 15, revenue from contract with customers. The lessor must apply that in splitting the contract that contains a lease component and a non-lease component. So this is how the topic we just look at, or the sub-topic we just look at, is what we call separation of lease. Separation of lease. Now we've done all the preliminary items. We've looked at what is a lease, what contract contains a lease, how to separate a lease component from a non-lease component, and the difference between lessee and then the lessor. So I want to end this particular lesson here, and then we will continue in our next lesson on lessee accounting. We will take lessor accounting, and then we'll take sale and leaseback. Please do not forget to subscribe and share with others. Thank you.